The first step of going with lower rates of interest is often proved to be beneficial for the investors. However, a lot of people are curious about how these rates would affect certain scenarios. Howard Marks offers his opinions on this.
Low interest rates. Generally speaking, I mean, the all-time lows of interest rates were hit during that period, and interest rates, while having been raised in recent years, are still extremely low.
Let's clarify a few things. Every time the economy starts to grow, the interest rates should be increased. When investors see a deal with a lower interest, they willingly increase their spending. It is simpler to borrow money when the rates are lower, and it makes it very simple to take benefit of an opportunity cost when borrowing something frequently. According to The Atlantic, the zero interest rate policy that was unintentionally implemented in December 2008 with the goal of stimulating the economy caused the largest increase in wealth disparity since the Great Depression. The wealthiest 1% had a 46% rise in net worth, while those that chose to save money were penalized to the tune of over $360 billion. When the rate is low, more people are interested to join in. It makes more capital available to the investors in different market value ranges. So lower interest rates are beneficial in increasing fragility as they play a major role of providing leverage. If an investor borrows a short on low rates, there is a possibility that he may lose it all. Overall, in an environment of low interest rates, boundless optimism can lead to overinvestment and excessive risk-taking. If you like Howard Marks' opinion about low interest rates, feel free to watch more videos like this through our channel. Hit like and share the video.